The Federal Reserve met today, keeping interest rates exactly where they are. I wanted to break down what happened in the stock market today. What the stock market giveth, the good stock market taketh right back. We saw a big spike right after the meeting. We knew what the Federal Reserve was likely to do, but then the stock market fell right back down. What happened, but more importantly, what to expect next. Give you a hint. Starbucks dropped 15%. Why? Consumers. Less people walking into the stores. Does Starbucks have a bad product? All of a sudden, no one wants their orange mocha frappuccinos? No, absolutely not. Higher interest rates for longer is going to affect the broader stock market as it affects consumers. Consumers are tightening their purses and wallets. Because of that, you're seeing revenues start to not hit their targets. We will see this broadly across the board. A lot of these value investments right now, not the time to pull the trigger. And we saw this in the stock market today. Let's jump in and I'll break down what I saw, what I'm looking at, what I expect in the future beyond the stock market today. Here we're looking at SPY stock. Actually, this is the S&P 500, same thing, just different. The timestamp down below, you can see first I'm in Mountain Time, Santa Fe, New Mexico, 2 hours behind New York. So you can see where the Federal Reserve finished its meeting, the big spike up, then the big sell-off immediately thereafter. We basically broke even for the day. It was pretty much flat for SPY stock today. Basically, and I've said this, take a look at Starbucks. This is sort of a really good indication of what will happen with the stock market moving forward. The consumer, if you want to know what's going to happen with the stock market, you need to pay attention to the consumer. The consumer, their rate of growth of incomes and expenditures drives the rate of growth of revenues for companies. And with high interest rates being higher for longer, for up to this period of time, and at least 6 more months until after the presidential election, that is pretty much what we're going to be watching. The Federal Reserve did nothing new today that we didn't expect. Now, we walked into this year with the expectation that they penciled in something like 3 cuts. And I've seen people talking previously that they had said, oh yeah, 6 cuts. And I think if you read this article here, it kind of breaks some things down. I know it's a Dow Jones Newswire. I broke off the bottom, obviously. They talked about 6 rate cuts walking into this year and how that was something of la la land. I walked into this year saying interest rates likely needed to go higher because inflation was sticky. I knew this going into this year. It's May 1st? People are finally catching up to that. Catching up to things I've talked about back in September of last year. September, October, November, December. I kept saying interest rates are not going down. So I laughed at all the things that were going on in the background. You need to pay attention to the consumer. If the rate of growth of incomes is increasing because more and more people are being hired, added to the aggregate for personal incomes, they spend at a pretty decent rate comparatively. We're maxed out. We have 3.8% unemployment. Where's the catalyst to push unemployment higher? There's a catalyst to restrict employment. Now we have non-farm payrolls hitting on Friday. But this one is really, boy, if this isn't telling, S-Bucks, $89, dropping all the way down to 72.5, like 15%. This is a huge move to the downside. Orange mocha frappuccinos have been cut out of the budget. Plain and simple. Starbucks has an excellent product. They're a great value investment. They continually have people walking in the stores up until last quarter because interest rates have been too high for too long. It's too restrictive. And income is a finite resource. There's only so many people earning so much money. And if you start to tax that income on what people are paying down in their credit cards, they have to give up something. the orange mocha frappuccino. Here's a bigger look at Starbucks, S-Bucks stock, and I think this really should be a wake-up call to anybody who is on some kind of thinking that the Federal Reserve is still going to cut interest rates this year. I don't see it. First, they will not cut interest rates prior to November 5th, Tuesday, Super Tuesday, the presidential election. They have a 2-day meeting on the 6th and 7th, right after the presidential election. More than likely, that is the first chance they will get to make a move. And maybe they do lower interest rates at that point. There's a problem. I think there is another meeting late December. I'm doubtful that they will make a move then, but the very most we can get out of the Fed would be those 2 cuts. At that point, with the lack of purchases of orange mocha frappuccinos, the S&P 500 on an aggregate basis will have sold off. Starbucks is not the only company in the economy. Now, we have AI stocks flying. They flew a little too high, a little too fast. Those stocks are likely to move forward as well. Here's a look at U.S. government treasury bonds. This is the 10-year benchmark rate, something I watch on a regular basis. And I still have the bottom right corner there. Of course, that was the stock market today. Bond yields initially sold off, moving right back upward. I don't expect much more movement in bond yields. Here's a weekly chart on the 10-year treasury, which we just saw. For me, I have been buying TLT stock, and I'm going to do a video tomorrow on TLT stock. For your average retail investor, this is an excellent way to get into the bond market. Now, as high as these yields are, there's an inverse relationship between price and yield. The eventuality is the Federal Reserve does move. I don't see a spike in the U.S. 10-year Treasury, given the information we have today, beyond 5%. I just don't see it. We're starting to see the effects of higher interest rates for longer on the consumer. We are not seeing incomes continually increasing. They've sort of flatlined. So expenditures is doing exactly the same thing. If incomes and expenditures are flatlining, there's no more new growth. So I don't expect inflation to spike up all of a sudden out of the blue, although inflation has been sticky. Give it 6 more months at this level, probably won't be sticky anymore. Here is a look at, this is actually SPY stock. My thinking on SPY stock, today's movement in the stock market today was pretty much what we're probably going to expect in the future. I expect SPY stock to go down below the 480 level, probably see a range between 380 and 480 for at least 3, 6, 9 months. Here's the thinking. If the Federal Reserve does make a move in November 6 and 7, guess what happens? It takes time for the relief to happen. Because of that, any moves that the Federal Reserve does in November, you're looking at 6 months out before we start to see the healing process and their accommodation affecting consumers, which would get them to spending more because they're not being restricted so much with their debt. Once they start spending a little more money, then businesses sit there and say, you know what, we can hire a few more. Employment is a lagging indicator. Once they start adding more jobs, these employers adding more jobs, then you'll see growth in stocks. Until then, I see SPY stock moving much lower. I break down the economy first and foremost before I look at what I think is going to happen with the stock market. And the question I always ask is, what's going to happen with the consumer? Are incomes growing at an expanding rate or are they shrinking? We're going to see incomes decline. We're going to see expenditures do exactly the same thing. Those expenditures turn into revenue for companies. The Federal Reserve will not lower interest rates before the presidential election. So don't look for any kind of moves in the bond market for 6 months. then the Federal Reserve may have to lower interest rates pretty rapidly to take care of the issues that they created with keeping interest rates higher for too long. That's why I'm getting into TLT stock. I've done videos on that. Make sure to follow along. Visit my Substack. I'm doing a post on this. It's on the free email newsletter. You're more than welcome to stop by that. Link is down below. If you're just finding my channel for the first time, hit the like and follow button. We'll see you in the next video.